Hello, I'm Michael Henley, the CEO and founder of Brandywine Private Wealth. I'm joined, as always, by Peter Kim, our Chief Investment Officer. And what a crazy start to 2026, Peter. Between the capture of Maduro in Venezuela, the war with Iran, all these different shocks, the market has been holding up pretty darn well, all things considered. What's been going on year to date in the capital markets?
Yeah, it's been very eventful, say, for the first 3 months of the year. Had you asked me 5 weeks ago, I would have said macros and fundamentals were very good. Obviously, the war with Iran kind of changes everything at this point, but by and large, we're seeing a little bit more volatility, but markets in the US down 5%, I'll say, for the year.
Okay.
To start, so not terrible, given how much volatility we've seen, the vibes that everyone has. You feel like the market should be way more than this.
You would think, yeah.
But international markets, relatively flat. Bond market, relatively flat. Seems like everyone's kind of shrugging this off as a relatively short-term event-driven scenario.
And ending 2025, going into 2026, international outperformed last year, so you expect that to continue, which it hasn't, right? Mm-hmm. You would expect AI, this kind of tech story, to continue to be getting tech higher, but tech's what, the worst performing sector this year?
Yeah, you're starting to see some cannibalization in tech from AI, and kind of where's the dark going to fall, where it gets really impacted and disrupted the most. Software right now is kind of the darling.
Okay.
That is getting the most impact and most eyes on it. But you're right, international markets last year did really well. They started the year doing really well. They're all obviously net importers of energy. So when oil prices spiked with the war of Iran, obviously their energy markets took a hit, and obviously the stock market's reflecting that too.
And what's been interesting is I think energy is the best performing sector this year, right? Which is fascinating. But even before the war with Iran, I guess they're kind of they're kind of protected from the AI risk, right?
They're a weird beneficiary of the AI race, right? Because all of a sudden energy needs are a big demand, and for all the data centers that people are building. So energy was kind of the last part of the value side that didn't really get any impact yet.
Okay.
You're right. Obviously the war in Iran kind of supercharged that, and now you're seeing it spike with oil prices up around 100 plus.
Interesting.
Dollars a barrel.
Yeah, fascinating. What is the latest news in the US markets?
Yeah, US markets, obviously the war with Iran is kind of driving everything. Fundamentals are still pretty good. Consumers are still spending. Earnings reports are still relatively good, at least for last year. We'll see what it looks like for this upcoming quarter.
Okay.
Obviously, we're going to have probably a relatively short-term spike in inflation with oil prices and gas shooting up by $1 plus at the pump.
That'll impact the consumer, right? But I guess if you're a long-term investor, what you care about is what future expected earnings, right?
Exactly.
Earnings are still pretty good.
Earnings are still very good for corporations. They're still continuing to expand their balance sheets. So that should be, at the back end of this, a very good tailwind for the markets to continue forward, as long as there's some sort of resolution with the war in Iran.
And we like to remind clients, we're not investing in shares of the economy, right? We're investing in shares of businesses.
Exactly.
As long as profits and earnings still continue, we're in good shape.
As long as the companies still continue to work and still make money, then the stock market in theory should continue to still go up.
Okay, awesome. How about international markets?
International markets started off really well, certainly dragged off a little bit as the war in Iran kind of escalated and you saw energy prices spike. Mm-hmm. It's kind of interesting in that they can't afford to have high energy prices. They need to have some sort of solution as fast as possible because their balance sheets cannot afford all these high energy costs. They're already spending money. They're planning on spending more money, given the US is kind of retrenching and coming away from their stance in terms of NATO and being the backstop for global defense. International markets, international countries have to kind of pick up the load there, especially in NATO. They're already expanding their balance sheets to spend more in infrastructure and AI as well, that they do not want to have a tech desert like they did back in the late 90s, and they kind of shrugged off all the tech boom. They want to make sure that doesn't happen again.
Okay, so I would expect if we end up with some sort of peace offering or what have you, or ceasefire, markets should rebound pretty sharply, one would imagine, right?
You would assume. Okay. That seems to be the growing sense right now, given that the markets are pretty resilient and kind of shrugging all this off, more or less. It seems like they're waiting for an event-driven spike to kind of send everything back down for oil and then send the markets back on.
Got it. Talk to us about gold. Gold, it seems to have been blockbuster year last year, very strong this year, cooled off a little bit.
It did. So gold did really well, kind of starting out a couple of years ago, specifically when the US kind of sanctioned Russia, and then everyone started dumping the US dollar and buying gold for the global reserve currencies. You've seen a little bit of that come back down now, as you're seeing a little bit of people selling that off for a more liquid asset base, given kind of the uncertainty that we have in the markets, for just some flexibility, it looks like.
Okay, makes a lot of sense. How about the latest news from the Federal Reserve and interest rates? We have a new Fed chairman, right?
Yep, coming up probably in May, as long as he gets sworn in, which seems like should be a relatively easy thing to do. I assume he's only getting his job if he's looking to cut rates at some point.
Sounds right. Yeah.
With the administration. So I got to think you have some sort of already bias built in for lower interest rates. I think rate hikes are pretty much off the table given how weak the economy is, how weak the labor market is, how stuck the housing market is. Raising rates kind of only exacerbates all of those issues.
Yep.
So I think rate hikes are pretty much off the table. At this point, it's more when do we get cuts and what are they going to look like? June, maybe, but at some point, probably down the line this year.
Okay. Are they still pricing in one or two cuts this year?
Seems like it's now pricing in one. I think we'll probably end up with one or two.
Okay.
Because I think the economy is going to need a little bit of stimulus to kind of spur some economic growth on the back end of this.
Got it. I guess there was a lot of talk about the refunds the taxpayers are going to get from the One Big Beautiful Bill Act last year.
Mm-hmm.
I guess now a lot of that's going to get eaten up at the gas pump, right?
They're still spending the refund, but you're right.
Yeah.
Instead of on paying down debt or on miscellaneous expenses, now it is basically just paying for gas.
Okay. Yep. Any updates to our portfolio models here at Brandywine?
So right now we're kind of peak uncertainty, peak unknown of where this can go. For us, it's diversify as much as we can. Thankfully, all of our model portfolios are already fully diversified, already at kind of max equity exposure for where we'd want them to be. So now we're just kind of just tweaking around the periphery, scaling back on some of the winners that had done really well for the last quarter, adding to some of the losers that have not done as well, but maintaining that target allocation.
Got it. So really, this most recent rebalance, we're kind of locking in gains on bonds, buying stocks on sale to some extent, right?
Yes.
Okay. That's great. All right. As you know, we like to talk about the 8 laws of investing. This quarter, we're going to talk about law number 3, which is most investing success comes from avoiding catastrophic mistakes. So Pierre, talk to us about what that means.
Yeah, so this really plays into the behavioral finance side of things, and that you don't want to be super optimistic or greedy at the market highs, and you don't want to be overly pessimistic at the market lows, because typically that's when you should be kind of doing the opposite of that.
Okay.
Right. And historically, when you look at the markets, they're kind of biased and rigged to always go up. Right? Companies exist to basically just make more money, add shareholder value, basically increasing value.
Yep.
So you just want to be a part of that over the long term. Tactically trying to time the market here and there, inevitably you're going to be wrong because you have to be timing to get out right, you have to time to get in right. But more importantly, when you should be getting in is kind of at peak despair moments. Okay, and that's the worst time or the toughest time to say.
And the media is saying, get out, the world is ending. And that's when you want to be a net buyer of stocks.
Exactly. And that's the toughest time emotionally, and it behaviorally gets it. Get in and say, yep, let's add in more risk into a portfolio.
Okay, so like always, ignore the noise, whatever the topic is, or the current catastrophe will pass, like it always does.
Absolutely.
We always say the 4 most dangerous words in investing are this time is different. And the 4 most powerful words are this too shall pass, right?
Exactly.
Because everything eventually does pass. Okay.
Markets like to grow, hold it for the long term, and you'll eventually be successful.
Awesome. Well, thanks, Pierre, as always. Really appreciate the time and insights as always. And if you have any questions, feel free to reach out to us at Brandywine Oak.